Hi everybody, it's Russell Markham here from VectorVest. Let's get the camera on here. Great to see so many of you along today. Great, what a topic today. So the hot topics of interest series. First one here, how to find the best dividend paying stocks paying 3% or more. What a series this is going to be. So make sure you come along to the remaining series. There's some very good stuff coming up. Okay, so let's move myself out of the way here and let's get into it. How to find those best dividend paying stocks paying 3% or more. Now, to set the scene, I want to refer you on to a report, Why Dividends Matter, by Dr. Ian Mortimer and Matthew Page. Very interesting. Two physicists, I believe, they got their doctorates in physics, and they effectively did some very interesting research. So what they did is as follows, and again, you can hop onto the internet and find this. It's not hard to find. Just type in Why Dividends Matter plus Guinness Atkinson. You can't miss it. It's out there on the internet for all to see. And let's jump back here. So just to set the scene, history has shown that companies growing their dividends year in and year out over the last 30 years, so this was a research done by the Atkinson Fund there over the last 30 years, in the US have been companies that have outperformed the market. Now, this research is highly applicable to Australia. All right, so the reason I'm sharing this with you is because it's some of the most comprehensive research out there in the world. Non-dividend payers or dividend cutters have not outperformed the market. So this is one of the reasons why we want those top dividend paying stocks. We want them because we want the dividends, the all-important dividends for our income. But we also want them, and we should also want them, because dividend payers will typically outperform non-dividend payers. So you'll see here, dividend growers and initiators and all dividend paying stocks have way outperformed dividend eliminators and cutters or non-dividend paying stocks. Now, if you think about it, if a company is in a good financial position, is it more or less likely to pay or exceed its dividend obligations? Of course, it's doing well, it's going to pay, right? Where companies are struggling, all right, so where companies are struggling, all right, they're cutting or eliminating their dividends, makes sense. They're trying to conserve cash, they're in financial trouble, all right, so they're trying to improve things. Okay, so let's get to it now. So we set the scene behind why we want those dividend pays. We want it for income, we want it because we want to do well with our capital growth. Let's go and find those dividend paying stocks paying 3% or better. So what I'll do here is I'll just put my pointer on here. So in here, my pointer options, there we go, all there are visible. So we'll keep the pointer on here. Okay. So let's set the scene. What's a dividend? If you're new, a dividend is a distribution of a portion of a company's earnings to shareholders. All right. So it's effectively just an amount paid for each share. So the way you can get the yield effectively is you can just divide the amount paid by the share times 100. So if a share was $1 and it was paying out 20 cents, 20 over 100 cents is 20% dividend yield. It'd be a very nice dividend yield, but it's most likely to pay, let's say, 2 or 3%. So it would be 2 or 3 cents on 100 cents to give you that yield. Okay. Let's go into VectorVest now, and let's go and find all of those top dividend-paying stocks. So I'm going to use the power of VectorVest here, and at the end I'll give you a link where you can trial out VectorVest should you choose for 30 days, where you can do all of this. And believe you me, the 10 US dollars, call it 13 Australian dollars equivalent, to trial out VectorVest is going to be more than worth it, because you're going to have a list of high-performing dividend yield-paying stocks. So let's go and list all the stocks at 3% or better, where it's greater than or equal to $2 on the share price. So I don't want any penny stocks. All right, so let's do that. So what I do in VectorVest, once you get access to the trial, should you choose, and for our subscribers, dividend watch lists. So you get this per our watch list viewer, per our views tab. Don't get too caught up with how to find it. It's pretty easy. We've got our support team that can always help you do it in seconds. I want you to concentrate on the methodology today. So what we do is we go and find all these top dividend paying stocks, 3% or more, where the share price is $2 or more, and then we sort those companies with the best combinations of fundamentals and technicals at the top of the list. So what do I mean by fundamentals? Those are the building blocks of a company. So shares with really good track records at meeting or exceeding what they said they're going to do. They've been around for a long time. They've got good management, all those key things, good cash flows. And then technicals, it's just a fancy way of saying shares going up nicely in price. So a good set of technicals is a share price going up smoothly from left to right, and there's all different ways you can measure it using fancy mathematical techniques. All right, so what if we were to go find those smooth left to right upward trending stocks with really good fundamentals, really good building blocks behind them? Okay, so let's move myself out the way here. And just so you know, just the other day, 23rd of April, there were 62 in total in the VectorVest system that met that criteria, at least from a 3% or better yield where the price was $2 or more. Okay, now let me ask you this. Which shares are the best? Just because I find a share price where it's $2 or more, where the yield is 3% or more, it doesn't mean effectively that it's going to be a top quality dividend payer. There's a few other things we need to check. We're going to get pretty close to finding some good dividend paying stocks, so a lot of the work would have already been done for us, but there's a few tweaks and balances I can show you to really get the most out of it. So which dividend payers are the most reliable? Sure, I might find a company that's paying 3 or 4%, it's greater than $2, but I find out, oh, hang on, it's been unreliable in the past, right? Just because I find a company where it's 2% or $2 or higher, where the yield is, let's say, 3 or 4%, are they actually looking to grow their dividends? They might actually be looking to eliminate those dividends. So we need to find those ones that are continuing to grow their dividends, those companies. And then the other thing here is I need to also make sure I've got companies that have earnings to back their dividends. All right, so I need earnings to back the dividends. A lot of companies out there have got more than enough earnings behind them to back their dividends, but there are a few from time to time where they don't have sufficient earnings to back the dividends, and we'll cover that. All right, so dividend payers watch list here. Here are best fundamental and technical stocks here. So what I've done here is just shown the first couple at the top of the list, where your dividend is at least 3% or better, and the price is at least $2 or better. Okay, so having said that, let's get into it. So here's our dividend in dollars and cents. Look at that. Wow, Fortescue Metals is paying out $2.47 per share dividends. Nice. But you look at this and you might say the one above. All right, NRO Group. Oh, hang on. It's only paying 14 cents. But hang on. 14 cents divided by $3.23 as a percentage equates to 4.33%. Oh, okay. Yeah, it's a pretty good dividend payer. So, just be aware of that, of course, if you're new to investing. All right, so if I run my eye down here, I go, wow, look at those dividends, phenomenal dividends. But guess what? I can afford to be fussy. I can afford to be very fussy. So I can say to myself, well, look, this one's below 4, and this one's below 4, and this one's below 4, and this one's below 4. And as such, the rest are higher than 4. So I'll pick on the higher ones. Okay, well, look, it's a good starting point, but we need to check a few more things to make sure they stack up. All right, well, let's move over to this column here, dividend safety. It's on a scale of 0 to 99. Kind of think of it like as your report card back in the day when you're at school. Right, maybe you're still at school and you're watching this today, this presentation. Great. I wish I'd learnt this skill set back when I was at school, because it would have saved me a lot of pain in my investing career that pursued thereafter. Let me show you this. Right, so you can see Mineral Resources got a dividend safety score of 82. That's an amazing score. Let me note this. In Australia, a dividend safety score of 60 or better is excellent. A 50 or better score is very good. Anything below 50, you want to be careful. So Mineral Resources have got an excellent dividend safety track record. So how consistent and reliable has Mineral Resources been at meeting or exceeding its dividends? Okay, so 82 is excellent. All right, but if I look through here, I can see, well, hang on, Ascent Group, 42. Yeah, so it's just below 50. So I need to just watch it carefully. And Think Childcare, yeah, look, it's below 50, but the rest are all well above 50 and a few well above 60 as well. So just two that I'm sort of flagging that, yeah, I need to be careful. All right, moving on. Dividend growth. Let's see, what are those companies looking to do in terms of growing their dividends? How often have you bought into a company? How often have you bought into a company where you're expecting a 2 or 3% dividend? You're expecting 2 or 3% dividend, and then what ends up happening, the company goes, well, sorry about that, we're chopping dividends and it's now zero. And you go, oh, okay, well, I've got to sell that company now, and I've got to go and look to buy another one because I really need the dividends for my retirement, or really need those dividends to save up for whatever you're saving up for. All right, and you're frustrated because you feel cheated, you feel robbed, that you bought into this company and now it's cut its dividends. So to avoid that disappointment, buy into companies that are growing their dividends. So what I want is, I want a positive figure here. I want a company to be growing its dividends. I don't want, so in this particular case here, if I click my slide set, there we are, negative 14%, Metacash. Metacash is looking to cut its dividend 14% on its 3.79. So it'll take it, around about the 3-odd mark, whatever it might be, a little bit around about there, the 3% mark. Okay, so you don't want that. So I'll flag this one as, it's something else to be aware of. All right, well, the rest look pretty good, and you might be looking at Fortescue Metals and saying, whoa, this one here, 11%, you sure you're going to get the 11% dividend yield? It's on track. Well, hang on. It's got a safety track record of 63, which is excellent. So it means it's met or exceeded its dividends in the past. Certainly did double digits last year on the yield. And it's looking to grow its dividends by a further 26% currently. That's what it's on track to do. So thank you very much to the iron ore price and the well-run Fortescue Metals company there. The group are doing a good job, clearly, because they are in a position to continue to grow their dividends. Companies don't typically increase dividends unless they're doing well. Okay, so I'm feeling pretty confident here. I'm going, well, was 11, there you might think, too good to be true. Oh, hang on. Yep, okay, good track record. Oh, hang on, looking to grow their dividends. Yeah, I'm feeling pretty confident, right? Okay, but there's another indicator that I want to draw your attention to. Earnings yield. Does the company have sufficient earnings to meet or exceed its dividends? So if we go back to Fortescue Metals, you look at this and go, well, 11%, wow, you sure it's going to meet that? Well, yep, safety is good, growth's good. Yeah, but it hasn't got enough money in the bank currently. Sure does. 13.71. It's got enough yield currently up its sleeve to meet that 11.4%. Okay. Look at this one here, Mineral Resources. Its earnings yield of 8.7%. That's theoretically what it could pay out. And it's paying out 3.86. So it's no wonder its safety track record is so strong, because even if things were to get a little bit rocky for Mineral Resources for whatever reason, it's got plenty of ammunition, so to speak, up its sleeve to meet or exceed that 3.86%. So it's got plenty of buffer behind it. Okay, so that's what I like to see. Where your earnings yield is less than the dividend yield, then you've got to be careful. And this is a question I've got to ask you. If a company has got less earnings than its dividends, then where is that company going to get the money to pay its dividends? It's got a couple of options. It can just not pay the dividends, not good for you, very frustrating. Or it can cut its dividends, again, which is not good for you, but at least you're getting something, but you're frustrated because you're not getting kind of what you thought you were going to get. Or it can pay its dividends, but it comes at a cost. It needs to borrow the money. The company needs to borrow money, puts the money debt onto the balance sheet, not good for you. Interest payments coming out of the cash flows. All right, not necessarily the best action for the company, so you can get your dividend. Oh, I got my dividend, but my share price is falling because the company's taken on too much debt. Okay, so we want the best of all worlds. I want a company that's got enough earnings, it's looking to grow its dividends, it's got a safety track record which stands up, it's got good dividend yield. That's what I'm after, and not a penny stock. All right. There's an additional 2 columns here I've put here just to note. You don't have to have these, but it's always very nice to have them, and I do always seek these out. I want to get franking credits, right? I want to get the all-important imputation credits there. So effectively what's happening there is that a company needs to pay 30 cents in the dollar tax on its earnings. What happens there is the company will have paid its 30% tax. It then pays out the dividend. And because the company's already paid its 30% tax, if you are at, let's say, a 0 tax rate, then you could get back the full 30% company tax because your tax rate is 0. You've got a franking credit that's had 30% tax paid to it. Because your tax is zero, you get that back as a tax rebate. Now again, I don't want to get too much into the intricacies behind it. Do speak to your financial professional on more information on that. I'm not licensed to give advice, so I don't want to get too much more into that, but suffice to say, if you can find companies that are fully franked, right, it's going to help lift that dividend yield up depending on where your marginal tax rate sits, right? And that can make those dividends even more lucrative. So Min Resources at 3.86, you get the franking credits. It can push it well over 4.5%, 5%. That's what you actually end up getting thanks to the all important franking credits. Okay, so I can see over here, all of these companies are fully franked, whether they pay out during the year or whether they pay out at the end of the year. A lot of companies pay out twice a year. They'll pay out during the interim sometime in the year, and then they'll have a final franking credit towards the end of the year. So just be aware, not all franking credits are fully 100%. You'll get companies that might only do 20, 30, 40% franked. You might get companies that do 100% on the interim, but then zero on the final, etc., etc. So what we do here at VectorVest is we make sure that you're fully informed at all times. So very useful. Okay, let's jump into the next one. This is just to remind you, just make sure your earnings exceeds your dividends. All right, so what I've done here is I've gone through and I've just ticked off a couple here that really jumped out at me. All right, so I didn't tick off Min Resources. Nothing wrong with Min Resources. Excellent dividend yield, just shy of 4%. Very good safety, one of the best there. Great dividend growth, great earnings, fully franked. Wow. The only reason I didn't pick it is because I had higher earning dividend yields here. I could earn more via the dividends. So I dropped that one out. This one here stacks up. Their group here, yields good, safety's good, looking to grow their dividends good, earnings covering the dividends, fully franked. Same with NRO Group, Fortescue Metals, all stacks up. Ascent Group, the reason I didn't pick this one here is because the safety track record was below 50. Okay, Nick Scali stood up well. Metacash, I dropped that one off, remember, because its dividend growth was negative. Right, Harvey Norman stacked up. JB Hi-Fi, Super Retail Group stacked up. Think Childcare, it's because the dividend safety had dropped below 50. BHP stacked up, and Evolution Mining here. The reason why I dropped that one off is because I was being fussy, because I could earn higher yield. So I dropped out the below 4% dividend yields. All right, again, nothing wrong with that, because you look at Evolution Mining here, you go, well, hang on, 3.35, still very good yield. Safety is 51, yep, pass mark. Dividend growth, very good, looking to grow their dividends, and they've got enough yield to cover the dividends. So nothing wrong with that company. It's just the fact that I could be fussy because I've got so many good stocks at my fingertips. All right, so moving forward here, so you can see over here where I've sort of just circled things that jumped out, and hence that's why those companies didn't get the tick. All right, so let's go and have a quick look graphically now, right? So here it is in graphical format. So Min Resources, although it didn't make our list because it was just below 4%, I could easily have put a tick next to that. In fact, it stacks right up. There's nothing wrong with that. But nonetheless, let me show you what is driving those dividends. So we've got this indicator in VectorVest called EPS, earnings per share. It's a 12-month leading forecast on earnings. It's not going to agree with your broker, right? So it's not like you can go to, Bloomberg or Thomson Reuters and say, I just want to double check something here. Okay, it's not going to agree with your broker, your fund manager, whoever it might be. This is a proprietary 12-month leading forecast in earnings. So where I can see a company where effectively the earnings are growing, that bodes well for the dividends. Because think about it, companies that are growing their earnings year in, year out, look at the correlation. Rising earnings, rising dividends paid. All right, look at the yield. Beautiful yield around about that 4% mark. Okay, let's look at the next one here. Metacash. Okay, so Metacash here. Now, if we go back to the prior slide there for Metacash, we dropped this one out because the dividend growth was negative percent. It was a negative percentage, 14. Okay, so if we go to Metacash here, and you can see the earnings are not quite as appealing as Min Resources. Min Resources are really rocketing up. Metacash has kind of gone sideways, but maybe that's why they're looking to reduce their dividends. They're all a bit concerned about the earnings outlook at the moment. But nonetheless, earnings have held steady. You can see here the dividends are they've sort of flatlined as the earnings have flatlined. Whereas the stock before, you can see as earnings went up, the dividends continue to go up. Here, the earnings have sort of flatlined and the dividends have flatlined. But still, a very attractive yield around about that 4%, but just need to be careful because earnings have flattened a bit. Ascent Group, you can see again, look at that. So, as the name notes, Ascent, it's certainly ascending, isn't it? The earnings are going up nicely and the dividends are coming up, and it's sitting just shy of 5%. So it's looking pretty good at the moment from a dividend perspective. Also from a capital perspective, capital growth, because companies that are growing their earnings are growing their dividends, are growing their share price. That's what you'll typically see time and time again. All right, so Wesfarmers, in fact, not typically, you will see a company that grows its dividends, you will see those earnings growing, you will see the share price growing. The earnings is your key driver behind this all. Okay, Wesfarmers here, you can see the earnings have sort of flatlined a wee bit here, but if I come back to your list over here, so you can have a look at all the different ones here. And so again, it depends where you want to come in, but for Wesfarmers here, again, you can bring this up into VectorVest and go and check all the different calcs on it, but in here you can see earnings coming up. It had sort of flattened a bit, and as such the dividends have flattened a bit. So for any one of these companies I'm bringing up, just to show you certain things here, you can go into VectorVest and you can effectively view all these indicators, and you can also then view it on the graph. Okay, so yeah, just bring some other examples here. You see earnings dropped off. All right, so as earnings come off, you see effectively the dividends come off. So I've just thrown a few extra examples in here for you. BHP, I've brought this up in here because a lot of people have held or like to comment about BHP and its earnings and its dividends. Look at this beautiful set of earnings in recent years now. After the mining sell down, things really turned around. Earnings have come back up and dividends have come back up. So you can see a strong correlation. Look at the yield there at about 5%. Very nice. Telstra. All right, so this is one here that a lot of us have no doubt held at some point in time, have been frustrated with in recent years. You can see as the earnings have come off, share prices come off, and your dividends have come off. So if you're holding on to Telstra saying, well, I don't really need to know anything, I'm just going to buy and hold and hope because I'm just after the dividends. My note there is, well, be careful, because you don't just want to buy, hold and hope when you're starting to see earnings falling. As earnings fall, dividends will fall, share price will fall. Why put yourself through that pain? Oh, but I'm getting a 4% dividend yield. Sure, you might be getting that 4% dividend yield, but how much have you lost on the capital erosion? A couple of years ago, Telstra was well over $5.50. And now today it's shy of $3. What's that? $3.50, around about the $3.50 mark. Okay, you've lost a lot of money on capital erosion. Why put yourself through that? Okay, CBA. Look at this. CBA's earnings just continue to slide. Hats off to CBA. While the earnings were falling, it did hold its dividends pretty steady. Certainly it wasn't growing them. And eventually, as those earnings continued to falter, eventually CBA's share price came off. Okay. And it's starting to impact in the yield now too. So you just need to be aware of that. You can only have earnings falling for so long till eventually you're going to get cuts to the dividends. Okay, and you're seeing the same theme with all the big banks. Westpac Bank had very good dividends over the years, but as you can see here, the earnings continue to fall off, dividends get cut, and yield deteriorates as such. You're seeing it with ANZ as well. Okay, so the big banks, they're under some earnings pressure at the moment, as you can see that for all sorts of reasons out there in the press. And same there with NAB. Macquarie Group, so that's our fifth biggest bank. I wanted to include that as well. Macquarie Group's probably had the best set of earnings across all the banks in Australia. This is one that certainly jumped out the most to me over the years. Its earnings were excellent at that time period here, and the dividends were going up. Then you've got coronavirus and panic and whatever took over. Earnings slid a bit, and Macquarie reduced its dividends pretty quickly, being fairly conservative, I suspect. on its dividends because it doesn't want to run the risk if earnings were going to continue to fall. It didn't want to put itself under financial pressure. So it looks to me like when earnings are picking up quickly, Macquarie Group are pretty generous in dishing out dividends, but at the same time too, when earnings start coming off, it looks like they're pretty aggressive at reducing those dividends. So you just need to be aware of that. So while the earnings are growing, you can expect dividends to grow. So I'll watch with interest. The earnings are just starting to tick back up to the upside, and no doubt you'll probably see those dividends lift up in due course. But again, please do speak to your financial advisor. I'm not licensed to give advice, all right? But you can see this. You can see those correlations time and time again, not just in Australia, but globally. So what I did is I took all of those companies that we put the little green ticks next to, right? So you can go back and watch the recording should you choose if you didn't get a chance to jot them down. This is the overall watch list of those companies, right? So you can do that in VectorVest with the power of VectorVest. You can do that. You can put them all into watch list and then you can view the overall result. Look at the correlation here. Rising portfolio price. So this is the average of all the stocks. Rising set of earnings. Earnings is your key driver, right? So as a note here, the key to managing your portfolio is ensuring you have consistent earnings. This is your dividend payers portfolio. Now, your rising earnings equates to a rising set of dividends. Again, there's that correlation, earnings and dividends. So again, I note over here, strong earnings, strong dividends, okay? And then the last thing I'm going to put in here in the middle here is the yield. You want to make sure that your yield is meeting what you're after. Now, I'm not saying there's not going to necessarily always be a correlation between earnings, dividends, and yield, because remember, your yield is calculated by the dividends divided by the share price, the average share price. Now, this is the average portfolio. As the average portfolio has gone up, those dividends effectively, the yields come under pressure unless the dividends pick up, because effectively your denominator, so your numerator would be the dividends in dollars and cents divided by the denominator being the average portfolio value times 100. So as this has gone up, you can see dividends have kept up. Why have dividends kept up? Because earnings are continuing to power up. So it's continuing to hold that yield on average around about just shy of 4%. So those companies there, they're collectively give you around about 4%, and they're fully franked. So your total yield at the end of the day is probably closer to 6% depending on your marginal tax rate. Okay, so as a note here, strong earnings, strong dividends, all right? So yet again, just to remind you. Okay, I want to leave you with something extra. Dividend aristocrats. So what we did in Australia is we got to work and we drew upon a lot of good research out there as well, and then did our additional research. We went and found some of the best dividend paying stocks over the last 15 to 20 years in Australia. Companies that consistently paid, a consistent dividend year in, year out on average. All right, so if you hop into VectorVest, if you get the chance, you'll get it under Viewers in the Viewers tab, and there's a watch list there called Dividend Aristocrats. And in that Dividend Aristocrats watch list here, what we're doing here is we're making sure we're giving you top dividend paying stocks that are not penny stocks, that they have good liquidity. Right, so you've got to make sure that these companies are doing a fair bit of trade taking place each day. So if you want to buy or sell them, you've got plenty of opportunity to do so. They've got a strong track record over the years of consistent dividend payments. That's what we're after. Okay. So what I've done here is I've given you a reference set. Let's see if I put a red circle. There we are. 19th of June last year, 2020, under Viewers. So under the Viewers tab, so you click on Viewers in VectorVest, you go to Views, and there it is. I'll just show you on VectorVest. Let's do this. So Viewers tab here, and you click on your Viewers tab, and then you go to your date. All right, so was it 2020? It was 19th of June, I think it was. There we are, 19 June. So just put your date in, and there it is. Dividend Aristocrats for Australia. I'm not going to give away all the trade secrets because I want to encourage you to take out a trial to see it for yourself. Believe me, if you spend a bit of time VectorVest, you'll never look back in terms of finding top quality stocks, top portfolios, top dividends, you name it, we do it all. All right, so I just want to point that out there to you, 19th of June 2020. And let me show you. So here is proof in the pudding. Dividend Aristocrats. This is the portfolio updated as of yesterday, as of time of the presentation here. So this was as of, I think, the 29th of April. 29th of April. Look how well it's done. So these are companies that are consistently growing their dividends, and as such, these are companies where the share price is on average going up, because companies with consistent dividends, remember, will typically be companies with consistent earnings profiles. So I'll give you a sneak peek. I'm not going to give you the stocks. Sorry to tease you a little bit, but I do want you to see this for yourself. All right, so it's important you see it for yourself. Dividend Aristocrats. So what I've done here is I've hidden the stocks because I don't want you to sort of quickly jot them down and then say, oh, well, there's no need to check out VectorVest. I kind of know it all already, because I'll not be doing you a favor. You need to see how it's done. All right, it's only $10. Give it a go, see what you think, because then I'm teaching you how to do it. You know, it's no point me saying, well, here we are on a plate, here are all the stocks, if I'm not showing you the methodology. If I show you the methodology, you can do it time and time again for yourself. Okay, so there it is. Here it's in play. And look at the dividends here. 5, 1.28, 3.84, 2.96. So some very good ones here. This one here is under pressure. Its safety scores dropped to 0, and the safety scores dropped to 0. So these companies are now under dividend pressure. But having said that, 78, 24, that's below the 50, so it's a little bit under pressure at the moment. 50's a pass, 69's good, 17's under a bit of pressure, so that's not a good score. 57, 69. So it's a little bit of a mixed bag at the moment in the Aristocrats as it's rebalancing, but nonetheless, it's doing an incredibly good job because the yield on average is well over 3%. And you can see over here, look at those returns on investments in recent times. So some very good returns on those stocks. So it's doing a good job on the capital growth, and it's doing an exceptional job on the dividend yield. All right, so if you get a chance, check out the Dividend Aristocrats, read up on the weekly essay that I wrote in the system, and there's a video that's associated with that write-up as well, and you can track it in VectorVest every day. I'll show you how to set it up in that weekly essay in the VectorVest system. Okay, so we also track some additional portfolios in VectorVest. So if you're after dividend paying type stocks, then you might want to look at this one here called the Safe and Sure portfolio. I'll show you where to find it shortly now in VectorVest, and I'm just giving you just a sneak peek with 2 stocks each. I don't want to give all the trade secrets away, so you might want to go and have a look at these. This one here, no surprises, we covered it today. And Inigo Group, that's another one we covered today, no surprises again for those 2, but look how it's performed, very nice. And this portfolio average picks up some very good dividend paying stocks. So averages over 12% a year with just 1 trade a month. Just to be clear, we're not fund managers and we're not brokers, all right? So we give you the tools, and you can then decide if you do or don't like a portfolio and follow it yourself should you choose, okay? So we give you all the tools. Growth portfolio. So this one here has done really well over the years. This one here, you're not going to be getting necessarily all the good dividends. You get some from time to time. So here, 2.54, but the Alliance Aviation Services not currently paying a dividend. But look at that capital growth, phenomenal stuff in recent years. Okay, so 25% a year on average with 1 trade a month. So you're not doing a lot of trades. We often get subscribers calling us saying, you know, I'm a little bit worried because, you know, I've only done a trade in the last 4 or 5 weeks. Am I following the system correctly? And I go, why are you worried? Yes, you are. I'm just feeling guilty because I've done so well. That's what it should be about. Investing should not be about burning the candle at both ends, being stressed all the time and unhappy. All right, it should be an enjoyable process. It becomes an enjoyable process when you've got the right tools, when you've got the right methodology. I used to be very stressed about my investing in early years because I didn't know what I was doing. Didn't have the right tools, didn't have the right temperament at the time, and I was just flying by the seat of my pants. Let us show you how you can do it each day with VectorVest. Okay, so if you want to know more, take it a trial, www.vectorvest.com.au/trial. There it is again, vectorvest.com.au/trial. I just wanted to note here that as a trialist, you would get the following. You'll get the following: up to 30 minutes free training by one of our Melbourne-based consultants. They call you up. You can share screens if you allow them to, and the team do a great job training up our new subscribers. You can get invited should you choose we invite you to our monthly online VectorVest investment gathering, and we cover some amazing topics, and a lot of our subscribers share some amazing opportunities on how to make money. I'll show you something interesting that we covered a while back that we then fleshed out a bit more. We were talking about the importance of iron ore a while back. All right, the amazing drive of iron ore. And again, I've hidden these so you can't see this because, again, I want you to take it a trial to see the methodology. But this is an iron ore portfolio. It's up over 30% this year so far. All right, this came about due to discussions that take place at the Online Investment Club. All right, so as a subscriber, you get access to that. You get access to our weekly videos and essays. So each week we do videos and essays, and we cover some amazing stuff. And you get access, as I noted there, to all the portfolios that I've just given you a little bit of a sneak peek today. I've just shown you one or two, but if I go to the VectorVest Portfolios tab, you can see here they all are. 10 stock model portfolio, ETFs portfolio, growth portfolio, income portfolio, safe and sure portfolio, the balanced portfolio. All right, you can see some pretty amazing returns from some of these portfolios in recent times. This is just over the last year. Okay, so I'm just about done for today. I'd like to thank everybody for coming along. If you've got any questions, give me an email, russellmarkham@vectorvest.com, and email support@vectorvest.com. All right. I hope I've given you plenty to think about today to find those top dividend paying stocks. Let's just go back, just recap it. One last look over here. So we covered all this great stuff, but let's just go back to where we had that spreadsheet type view. There we are. That's what I want you to get good at. And you know what? You can do it in seconds with VectorVest. All right. Is my yield stacking up? Is my safety stacking up? Have I got good growth? Are my earnings covering my dividend yield? Am I getting my franking credits? Yes. Next step, go and graph the stock. Are the earnings still trending up smoothly? Is the share price smooth from left to right? Great. That's a company that makes your shortlist for consideration. I'll leave it there because a few of you are asking for that list again. There it is. That's just a few. You can do this each and every day. I've only just done a handful here. You can build yourself up a very, very high performing portfolio that pays very good dividends in seconds each day using VectorVest. All right, so I'll wrap it up over here. Thank you for coming along. I hope you got a lot out of it. My name's Russell Markham, Director of Education for VectorVest Asia Pacific. It's been my pleasure having you along today. Have a great weekend, everybody. Bye for now.